It's the most common mistake in financial analysis, staring at a single rising line and assuming the market is strong. You watch the price climb higher and higher, buy in, and then, without warning, the floor collapses. That happens because looking solely at price data is like watching a car speed down a highway without checking the gas gauge. It tells you exactly what the market did in the past, but it reveals absolutely nothing about the intensity of the buying pressure or how sustainable that momentum actually is. When you rely on price alone, classic technical patterns become dangerous traps. An upside breakout or the resolution of a triangle might look like a clear buy signal, but if analyzed in a vacuum, those moves are often false starts that quickly reverse. To separate the real trends from the traps, technicians use a three-dimensional approach. We start with the price layer, but then we add a secondary layer for volume and a third distinct layer for open interest. This framework tracks the actual mechanics of the market. Volume measures the sheer number of entities traded during a specific period, while open interest measures the net creation of brand new capital contracts. Integrating all three metrics shifts your perspective entirely. Instead of simply reacting to where the price has already been, you can read the underlying flow of money and anticipate where the market is structurally preparing to go next. Let's start with the second dimension. Volume is the direct measure of urgency. It represents the raw buying or selling pressure behind a given market move. The baseline rule for volume analysis is straightforward. Trading activity must expand in the direction of the prevailing price trend. If prices are moving higher, the volume should be heavier on the days the market goes up and lighter on the days it dips. This chart of Black & Decker shows exactly what a confirmed, healthy trend looks like. As the daily price rallies upward, you can see the corresponding volume bars at the bottom expanding noticeably. The heavier volume proves that real buying pressure is driving the advance. However, trying to eyeball raw vertical volume bars across months of daily trading data is imprecise. It is incredibly easy to miss subtle shifting trends in the flow of capital when you're looking at a crowded row of spikes. To eliminate that human error, analysts use a metric called on-balance volume, or OBV. OBV produces a continuous curving line by maintaining a running cumulative total of trading volume. If a market closes higher for the day, that day's entire volume is assigned a positive value and added to the total. If it closes lower, the volume is assigned a negative value and subtracted. Looking at this daily chart for Compaq, the OBV line plotted along the bottom makes the volume trend immediately clear. The running total creates a rising line that perfectly mirrors the upward series of peaks and troughs in the price action above it. But the true value of OBV appears when it stops mirroring the price. This Intel chart illustrates a classic bearish divergence. Notice how the price trend continues to push into new highs, but the OBV line fails to follow, trending distinctly lower. Because volume precedes price, this divergence is a severe warning. It provides mathematical proof that the upside buying pressure is bleeding out of the market, signaling the uptrend is exhausted before the actual price reverses. While volume applies to all markets, shifting our focus to the derivative markets, specifically futures and options, introduces the third dimension of our analysis. This third metric is open interest. It is critical to understand that open interest is not a measure of daily turnover. It is the total number of outstanding, unliquidated contracts that exist at the end of a trading day. A single contract only exists because two market participants agreed to create it. For every buyer initiating a long position, there must be a seller taking the opposite short position. Together, they combine to create exactly one contract. Every time a trade is completed on the exchange floor, it alters the total open interest tally in one of four specific ways. First, if both the buyer and the seller are initiating brand new positions, a new contract is established. The net open interest increases by 1. Second, if one trader is entering a new trade, but the other participant is merely liquidating an old position, it creates a standoff. One enters, one exits, and the total number of outstanding contracts remains entirely unchanged. Finally, if both traders are liquidating old positions simultaneously, a contract is officially closed out, and the total open interest decreases by 1. By tracking these daily changes, you can definitively determine the nature of a price trend. Increasing open interest means new capital is actively flowing into the market, while decreasing open interest means old capital is being forced to exit. we can synthesize price direction and open interest data into 4 objective rules for grading the strength of any market trend. This table lays out the matrix. Rule number 1. A rising price combined with rising open interest is definitively bullish. This combination proves the rally is legitimate. Aggressive new money is actively flowing into the market, supporting the upward trajectory. Rule number 2 flips that logic. Looking at this daily chart for gold futures, we see a rising price, but it is accompanied by a sharply declining open interest line. This opposing geometry is distinctly bearish. Because the number of outstanding contracts is dropping, we know money is actually leaving the market. The price is only going up because holders of losing short positions are panicking and being forced to buy back their contracts. Once this mandatory short covering is complete, the rally will die. Rule number 3 applies to downtrends. On this chart of copper, a long, sustained price drop is mirrored by a steadily rising open interest line. That combination is highly bearish. The rising open interest confirms that new capital is actively entering the market to bet against it. Aggressive short sellers are dominating the trade, increasing the probability that the decline will continue. Rule number 4 covers a scenario that often confuses novice analysts: a declining price paired with declining open interest. This is actually a bullish signal. This indicates that the price isn't dropping because of aggressive new short sellers entering the fray. Instead, it's driven by long liquidation, discouraged buyers finally giving up and closing their old positions. Because no new capital is joining the descent, the selling pressure eventually runs out of steam. Once these weak-handed longs are flushed out, the market is structurally primed for a rebound. By routing price action through these 4 rules, you strip away the noise. You can accurately grade the structural integrity of a trend and avoid buying into false breakouts or selling during exhausted dead cat bounces. Up to this point, we've treated open interest as a monolithic number, but the US government strictly categorizes exactly who is holding those outstanding contracts. Twice a month, the Commodity Futures Trading Commission releases the Commitments of Traders, or COT, report. For advanced technicians, this document is an indispensable forecasting tool. The report breaks down the total open interest into 3 distinct groups. First are the commercials, which are large corporate entities using the markets primarily to hedge their business risks. Next are the large speculators, typically commodity funds relying on trend-following systems. Finally, there are the small traders, representing the general retail public. Analyzing this data relies on one guiding principle. At major market turning points, the large commercial hedgers are generally correct, while the speculators and retail traders are notoriously wrong. In this weekly S&P 500 futures chart, the lower panel plots the net positions of commercials as a solid line and speculators as a dashed line. Notice the buy signals trigger exactly when commercial hedgers are heavily net long, while speculators are trapped net short. This represents the full capability of the 3-dimensional model. Price charts revealed the current path of the market. On-balance volume uncovers the true underlying pressure pushing that price. And categorized open interest exposes exactly which participants are driving those capital flows. Mastering the integration of these 3 metrics elevates your analysis. It takes trading from a game of reactive guesswork and turns it into a discipline of structural, evidence-based anticipation. Up to this point, we've treated open interest as a monolithic number, but in the futures markets, the US government strictly categorizes exactly who is holding those outstanding contracts. Twice a month, the Commodity Futures Trading Commission releases the Commitments of Traders, or COT, report. For advanced technicians, this document is an indispensable forecasting tool. The report breaks down the total open interest into 3 distinct groups. First are the commercials, which are large corporate entities using the markets primarily to hedge their business risks. Next are the large speculators, typically commodity funds relying on trend-following systems. Finally, there are the small traders, representing the general retail public. Analyzing this data relies on one guiding principle. At major market turning points, the large commercial hedgers are generally correct, while the speculators and retail traders are notoriously wrong. We can plot these net positions directly onto a chart to find market extremes. In this weekly S&P 500 futures chart, the lower panel plots the net positions of the commercials as a solid line, and the large speculators as a dashed line. The most profitable buy signals emerge during periods of extreme divergence. Notice exactly when the buying opportunities trigger. It is the precise moment when the solid line shows commercial hedgers pushing into heavily net long positions, while the dashed line shows speculators trapped heavily net short. This represents the full capability of the three-dimensional model. Price charts reveal the current path of the market. On-balance volume uncovers the true underlying pressure pushing that price, and categorized open interest exposes exactly which participants are driving those capital flows. Mastering the integration of these three metrics elevates your analysis. It takes trading from a game of reactive guesswork and turns it into a discipline of structural, evidence-based anticipation.